All right. I spoke to Chip and Andrew, and you just suggest I'll go first, so I will go first. And I'm not sure we'll fit Elliot in because he just spoke, but then we'll follow up with Andrew excuse me, and Chip Perkins. I'd like to share something real quick.
Yep.
Does everyone see that?
Yeah.
Okay, so this is the IV Family Office Network Alpha Strategies. And I threw in great rotation because we're looking for are where we see new alpha being generated. And I have a few thoughts on that. One, I think, of the best durable indicators on the market is what is known as the Fed model or the risk premium model. And basically what that compares is the earnings yield of the S&P 500 to the 10-year US Treasury. And it got extremely expensive at the peak of the market in 2000. Does anyone see that red arrow? It was -3 or -2.5. And it got very, very cheap or very compelling at the bottom of the financial crisis, where it was 6. And it also got cheap again in the COVID crash a few years ago in 2020. In March, it got over 6. And both of these periods, we were buyers. And what I am concerned about is right now that risk premium is at 0.2. It's close to 0. And that's generally a good time to be cautious. Another factor that I think it needs to be taken into account is interest rates. Interest rates for 40 years have been declining. They're no longer declining. Where interest rates go is uncertain, but for the last 40 years, that drove stocks, bonds, and real estate. And I think people's expectation from those asset classes tends to suffer recency bias. And you just have to be careful about the 60-40 as a consequence. One of the issues is that our debt is very high. It's the highest relative to GDP since World War II. And the interest on debt, now that interest rates are going up, is suddenly becoming a real problem. It's over $1 trillion a year. That's more than we spend on our military spending. And one of the issues and one of the consensuses right now in the marketplace is, well, interest rates are, or inflation is going to go back to 2% because it's come down. I think the Fed, people should recall, really has done a terrible job. They changed their policy. They backed away in 2020 after the Jackson Hole meeting and said, we can allow a little transitory inflation. And suddenly we had 20% inflation over the last 4 years. And now they're saying, we'll get inflation down to 2%. I hope so, but I'm not sure. Will tariffs cause inflation? I don't know. Will Elon Musk and Vivek Ramaswamy cut 2 trillion out of the deficit? That would be very helpful, but we just don't know. Another concern that I have is I think during this period of declining interest rates, you've had large cap weighted indices like the NASDAQ 100 and the S&P 500 have these parabolic moves, and things now look very, very expensive, all concentrated on these mega cap stocks. I think that's emblematic of a potential peak. Hello?
Keep on going.
The reason I'm very passionate about this is back in 2000 or late 99, I set up a hedge fund. And in 5 short months, I took about 12 million to 24 million, and that was up 112%. I think Jesse Livermore, the famed Wall Street trader, in reminiscences of an operator, said, In making money, I learned nothing. In losing it, I learned everything. I'll mention later that I won the USA Today CNBC National Investment Challenge. I was up 1,078% in 1992 trading biotech stock. So there have been times where I put up great numbers, but I've also lost money, and that's what leads me to the belief that we're going to see a rotation and that caution is necessary today. And what I've learned following the 2000 peak, after I had this top performing tech hedge fund, is the emerging markets and international and everything but the US performed well. And I think we are in a similar environment. Going forward, we should be looking there. In addition to that, the sectors. I think looking at energy and mining, gold, materials, that's where to be. And financials and tech will not be where to be over the next 10 years. Part of that has to do with NVIDIA and the Magnificent Seven, which have had these parabolic runs. They have done tremendously well, but what we're starting to see is decelerating earnings in NVIDIA. And I think that we are seeing a big rollover here, and that's starting to be manifested here. This is Ari Wald, a OpCo technician, and showing that smaller caps are now starting to do better. Gold has been doing well. It should do well, though I think I listened to an economist earlier who I'd say, yes, we've had a big move. So it may pause, but I think that it historically should do well, as should energy. One area that I'm investing, as opposed to some of these more sophisticated products offered by some of my colleagues or presented here today, is I'm focusing on generating a lot of income. And there are a lot of places where that can happen. Closed-end high yield funds, closed-end equity funds with yields you can generate at Interactive Brokers. Their money market is yielding over 4%. And some of these equity closed-end funds are generating 12%. The high yield funds also around 11%. And MLPs are yielding 7.7. But the thing about MLPs is their distribution tends to be return of capital. So that's really a taxable equivalent. So I was showing a customer this that I thought people would find interesting. You can put 25% of your money just in a money market and allocate the others between MLPs, high yield closed-end funds, equity funds, investing in places like India, Asia, and you can get an 8.5, 8.5% yield. And I think that that's a very safe play. Sorry, I'm just. What we're going to do is we have some tremendously talented speakers. And so what we're going to do is we're going to have Andrew or Andy Fish of Five Oceans Group give us his perspective on what he sees. And he is the CEO of Five Oceans Group.
Tyson, can you take down your down?
Is the red light? Yeah. Red light on.
Sorry. Hold on. Stop share. This should do it. There you go. I'm so sorry, gentlemen.
I have no microphone.
Yeah.
I think the battery's dead.
So you can try the one on top.
You want me to go up there?
That's fine.
Working. Anyway, thanks, Tyson. You actually just saved me my first 5 minutes. Going through some of that at least. I spent 40 years as a so-called professional investor. First 20 of it in family school, running a hedge fund, writing hundreds of thousands of lines of code because they do all yourself. And then I ran through venture capital funds, investing in the technology that I saw happen. After 20 years, I went to the dark side and built and ran a global fund of hedge funds for State Street Bank, which did fairly well because we approached fund-to-fund investing differently than most. And in 17, I left institutional wealth, went back to family office investing because there was no opportunity in hedge funds in 2017 for the reasons Tyson mentioned. Rates were zero, inflation was zero, defaults were zero, volatility was zero, and the pandemic changed all that. The Fed went from zero, raised to 5%. Well, 5% is not high, they did it faster than ever been done in history. And the game changed, as Tyson pointed out. We're going to talk about alpha. And so I was coming at it from a hedge fund perspective, but Marty talked about all the venture capital companies that are out there, venture-backed companies that are out there doing very well. So I'm actually going to spend the last 5 minutes talking about alpha in secondary venture investing as well, since we did that. The first thing is to do the old-fashioned separate beta from alpha. So again, Tyson talked about Magnificent Seven. These technology companies, and some of them probably know better, but about 25% of the S&P returns is NVIDIA itself. But one of the reasons actually is that all of those big tech companies don't have any debt. So interest rates going up made no difference to them, not at all. Now the Russell 2000, all those mid-market companies, it looks like the index looks like it's in a different country. Doesn't even look like it's in the United States because they do have high yield debt and they do have floating rate loans and they do have things that do affect their profitability. So there's beta in the stock market, and then we heard before macro guy talking about Bitcoin. There's only 21 million Bitcoins you can create by a Satoshi. So it can't be a reserve currency because it can't grow. So that's just data. It goes up, it goes down. I couldn't tell you the story. But that's not a source of alpha. It's the point you guys decided to do that. So both of those are beta. Okay. So how do we get alpha in a world where there's so much beta? Well, you've got to look elsewhere. Sometimes looking elsewhere isn't even looking far away. I've seen some very good small funds, and they're small for a reason, that do VIX arbitrage, volatility arbitrage in the S&P 500. Relatively simple strategies, just that you can't do them with $100 billion. So they're not done by huge funds. By the way, even with large money, Citadel is the perfect example of a massive organization that made all its money on alpha. They're not a beta shop, they never were. And they're one of the very few. So it can be done, and there are places to do it. The good part for a room full of family office investors is what has changed in the last decade is some, not all, of these types of alpha are available from your brokerage firm. They can put into products that you could actually just go out and buy. You don't have to be a specialized investor in hedge funds to be able to do some of them. Some of them do not belong there. And I'll get to a little bit of what's not. So things such as direct lending. Well, direct lending is beta. On the other hand, there's what's called specialty finance. So if you're just doing trade finance, or you're just doing litigation finance, or you're doing reinsurance, there's alpha in doing that if you have the right people to do it. The other places to go are the more complex things. Now, this part is sometimes harder to do, but sometimes not as much. Again, so I had, when I left the institutional world in 2017, had a very, very big portfolio in CLO, triple B, and double B. It was 9.5% of a funded hedge fund, very, very large for a fund, because it wasn't, as he said, there wasn't much to do. But CLOs are a complex mechanism where you have triple A's and double A's, and it goes down to the equity. And I'm not going to get into tranche debt, but the bottom asset are broadly syndicated loans in very, very good companies. They're loans to Dell, they're loans to all the companies that you know. Of course, as I said, Apple and NVIDIA do not need debt, but lots of other companies do, Delta Airlines, whatever. So these are not fringe companies. On the other hand, you can get a lot lower return by investing in a high yield fund, closed-end fund, mutual fund, whatever, you can buy them. Those are very low rated companies. Now, we don't see a lot of defaults, they're okay right now, but the return is only in the 5.5% to 8% area, where CLO mezzanine debt is double that. And there's even products you can buy that invest in CLO equity alone. You can literally go out and buy that from your JP Morgan broker. So a lot of the alpha that was left to the citadels of the world is available in the family office world today. Unfortunately, it requires some complexity. So I'll give you like a really one. So I was talking about Europe falling apart. Apollo is putting massive amounts of money into Germany because all the German companies borrowed at negative rates. Well, that's over. The game's over and there's no capital. So there's a scarcity of capital in a place in the world that they have expertise. Now, accessing Apollo's funds is not the easiest thing in the world, but where there's a will, there's a way. So these are all sources of alpha in the world because the world is no longer this monolithic thing that we described at the beginning. That rates aren't zero. In fact, we're talking about gold going up. I had a conversation a few years ago when gold hadn't gone up, and somebody said, oh, gold's not going up, inflation's going up. I said, well, if you own yen or euro, your gold has gone through the roof. If you're a Japanese investor, go look at gold in yen terms. It is up way more than it is in dollar terms, and at the time it hadn't even rallied very much. So the last part that Tyson didn't get to is that we are at a transition where globalization is in reverse. For 25 years, we've had globalization, facing the synchronicity in the world. One of the reasons we never had inflation is central banks went crazy, and they have gone crazy, $9 trillion at the Fed. But every central bank did the same thing at the same time, so the currencies and inflation didn't differentiate. Well, that changed a few years ago. The Japanese central bank, as you can see, is holding rates down, and their currency has plummeted as a result. So the globalization of the financial markets is reversed, but obviously the politics, I don't want to get into it. All of you guys can look out there and see what's going on with China and Europe and protectionism and tariffs and all that kind of stuff. That's all fodder for alpha, is all I'm trying to say. I don't want to get into what's what, but because things are not all the same, there are alpha opportunities. There are opportunities to look at different assets and look at the relationship between them or the complexity within them, as in CLOs are basically just corporate loans, but because the structures are so complicated, you go, what are these guys talking about? Well, at the end of the story, you're risking a very, very high default level of good US companies in defaulting on loans. That's what you're really worried about. And that's all you have to think about. So there is alpha because most people don't understand. Now, there are 140 CLO managers in the world, it's not many. Some of them are Blackstone, some of them are mom and pop, and a whole bunch in the middle are hedge funds. So it's there if you go looking for it. And just understand out of all the complexity, they're just loans. And they're loans to very high quality companies. The VIX arbitrage, it's arbitrage on the VIX.
How did CLOs do in 2008?
Actually, CLO, the lowest mezzanine tranche, the cash flows got cut off for 3 months in 2008. And the cash flows are very high, by the way. So it's called self-curing. The cash flows get cut off, but then they start getting paid back again. So the worst part of CLO tranches in 2008 only got cut off for 3 months. And then it's been fine ever since then. Even 2002 as well.
So where's your defaults?
There were no mezzanine CLO defaults at all. The defaults were all in the loans, the underlying loans, the default, and you have to get above the 7% default rate before they start impairing the CLO tranches, by the way. So the standard default rates of loans has not impaired CLOs, even the lower tranches, forget the double A's and triple A's. We're talking about the ones that we would be interested in. So that's all history, by the way. You can go back and look. It's all there. So that's why I'm bringing it up. It's not a new invention. It's not something brand new. So I guess the end of this part would be a lot of what is old is new again. And one of the reasons I'm sitting here, a lot of old hedge fund guys that we made money like 15 years ago coming back to me saying, let's put the band back together. We made money on these kind of trades. Let's go back and look at this kind of stuff again because there's nothing to do for a decade. Okay, so I'm going to take the last couple of minutes and talk about venture capital secondaries.
Can I just make one remark about these I mean,
Please.
You know, when it comes to hedge fund strategies, they don't necessarily repeat though, right? They may rhyme. Right.
Too many speeches that, the history rhymes doesn't repeat. My other one, Marty, is there's 20 once in 100-year events every century. Just every 7 years, there's a
I'm
different.
just telling you, I've had 20 guys come to me who, stopped their hedge fund in 2010 or 2012, and now they're trying to get the band back together. And I'm like,
so here's
you're 70 years old, you don't know tech,
So
right?
Marty, you're right on. So it rhymes, it doesn't repeat. When I say you go back to it, if you go back to that same old trade, trust me, it ain't gonna work. The world has changed, it's become efficient. People like this are making fundamental analysis more efficient than it used to be. You can't just go back and do the same trade. They are simply saying the environment, as Tyson pointed out, has changed in the last number of years. Therefore, there are alpha opportunities that we can receive. That's what we're trying to say.
I'm just wondering if the scale is anywhere close.
No, you're right on. You're right on. So no, don't just go back to what we did before. That's not.
That's sort of a contentious question.
I love it. Go ahead.
You look at Hercules Capital, publicly traded, the stock went from 15 to 21 in 52 weeks. It's paying, I don't know, a yield of 10%. Unbelievably successful in terms of very low default rates on their venture capital lending and their hedge, whatever, they're very diverse.
They do VC lending. I don't know.
You should look at the company.
I'm just asking, do they do VC
Yes,
lending?
yes.
Because there was no such thing as venture lending.
Okay, my point is, it has stock options as well, so you can hedge your position. So why do I need a manager? I mean, at the end of the day, this
If you
company
are
has-
really good at
I don't have to be
trading,
good.
I traded options for 12 years, and so if you're really good at doing it, you don't. But I don't know how many people in the room have
Okay,
sufficient
so you don't know Hercules Capital, so you don't know what's wrong. Okay,
No, I'm not a
That
stock
was my
picker.
question.
That's- Maybe Elliot can reply to that. I do know venture lending, and I do know that in my last talk about venture capital secondaries, stay away from any venture-backed company that's in debt. That's all I can tell you about that part. I did specialty finance starting in 2012. Sounds like anyone mentioned direct lending, it's not. Okay, we build portfolios for pension funds in specialty finance. Venture lending shouldn't exist, in my opinion, but anyway. So the secondary market of venture, as Marty
But it
pointed out,
does.
well,
It
it
does
does,
well.
but we can have a whole session on it, but I don't want.
no, but my point would be, if you're so worried about it, you buy the put.
If you can hedge,
That's that's the end of my
It's
sentence.
the reason those venture funds are, the venture debt funds are doing well is they're positioning to do takeovers of the companies and force them into foreclosure and wipe out the actual asset.
and my question to the lender was, are you willing to own the company as part of your workout process? And 99% said no. And I agree with you, that
They're
is
not
actually-
directly owning them, they're setting them into a
It's-
subsidiary, selling the debt
You
and
know-
then taking
You know
over.
what a rights offering is? Okay, I ran a VC fund through the .com list, so I know what rights offerings are. But I don't wanna go there because Marty's point was, this is unusual, by the way. There are 1,300 really good companies that we don't have to do that with. I am simply saying as a filter in the venture capital world, just filter out the ones you get. If you're doing this strategy, not your strategy. Okay, so that's a distressed strategy, and I'm not talking about that. So the differences, and the reason I want to bring this up is there's a big push for secondary LP purchases. There is no alpha in doing it, there's risk, I will tell you why. Because you are inheriting the general partner of the LP interest you are buying, and you are not their original investor. So you have very little transparency into the general partner, who themselves may be in trouble. Sequoia, I'm sending out letters about FTX, I'm like, oh my God, people are quitting Sequoia? That's the golden standard, right? Well, even there are. So you don't want to inherit somebody else's problem, is what I'm really getting at. And you want transparency. So if you're an LP in a VC fund, you have transparency to your GP, you have transparency to the underlying portfolio. So if you are going to do it, and there are people doing it, find somebody buying secondary interest in those companies directly. And to his point, those are distressed companies, but there are companies, because their VC backers have backed away, there are companies willing to do down rounds in good companies and sell secondary shares. So your fund manager will own the shares. They can be selective, they can filter out direct lending if you believe me, if you don't believe me, go ahead, it's a matter. And so you have transparency right to the company itself. And Marty's right, this is a unique experience. I did my first VC deal in 1994, and I was already 10 years investing at that point. So I've seen these cycles, been through these cycles. This is unique, please.
So related to that, how much of what you were talking about and the issue with Hercules is related to going from ridiculous 0 interest rates back up to nominal?
Depends on the company, I just said. So those companies like NVIDIA and Meta, they don't have debt, so they don't care. Right? The average Russell 2000 company that's got to refi its high yield debt from 5.5. Yeah, not a problem. There you go. The average Russell 2000 company that's got high yield debt, just refi from 5.5 to 8.5. The high yield's about 5 to 7 year duration. So those floating rate loans and the CLOs to those companies, it doesn't affect their profitability. So there's a bifurcation of companies. I'm just talking about the United States. I said globalization, that's a whole other conversation. Apollo's gonna do direct lending in Germany, better than doing it here. But they can, and I can't, and maybe somebody else can.
Okay.
Does that answer your question?
Yeah, sort of.
Or go ahead.
The last conversation I had with a venture debt company, just touching base, because I've yet to use one as a source of funding, was with rates up now, everyone's got sticker shock. You know, and if we go and invest, it's got to be a very small minority of the cap table. But the way rates are, we're not getting any traction with the rates that we're going to, you know, our cost of capital. So essentially, we wind up looking like a reorg company.
Well, that's what
It's all fees.
That's what he's talking about. So look at why they took the debt. A lot of them took the debt to avoid doing a down round because their valuation went up and up and up and up, and the next round was gonna be a down round, and they wanted to avoid a down round, so they borrowed money. And they were good companies, as Marty said, they were perfectly good companies, but their growth curve was supposed to be like this, and the growth curve was just like that, and now you're adding debt to a venture-backed company instead. Now, I'm not saying 100% of them you should eliminate. I am saying you should look carefully, and as you pointed out, if it's a very small part of the cap table, you can do it. You just extinguish the debt, right?
Yeah, but you know, they're having a hard time growing the fund because nobody wants their money at the rates they're charging, because essentially it all has to be fees. It can't be the upfront. So it's all on the back end, which makes them look and sound and functionally be a reorg.
Well, venture debt has, I mean, I should bring charts to the next one, okay? Venture debt went like this, and it's this, and it's going away.
Yeah.
Or at least it's got way back. In fact, direct lending itself has completely plateaued and petered out. Mostly because a lot of the best direct lending people, and I'll name them because they're in public. I'm not picking on these because Oaktree and Brookfield, two places I have the most respect for. I've known the emerging market debt people at Oaktree for 25 years. They are great. And then they put together this public product that's on your brokerage firm that is just, it's a square peg in a round hole. I think it's got a lot of fees, it yields about 5%. And these are some of the best investors I've ever seen in my career. And it just doesn't work. So the square peg in a round hole thing to be careful of. Again, I'm making generalizations, it's not a 2-hour speech, you know.
So venture debt may be in decline, but secondaries has gone through the roof, right? I mean,
So Marty, what I'm trying to say is secondary LPs are different than secondary shares. That's all I'm trying to say. So the secondary LPs, you have layers of a GP. You're buying an LP in a GP. The GP owns shares or invested shares in a company, 3 layers. So I did this in 2009. I was running global fund of hedge funds. We bought hedge funds in the secondary market. You know what the biggest risk was? We knew the assets. The biggest risk was the manager being on fire. When you went in and the manager was at its hair on fire, then you have to look at the whole portfolio. So sometimes we literally bought portfolios and left the managers at. So I'm saying the same thing in venture. Look at the health of the general partner of the LP that you are buying, not just the discount, not just what companies are in the portfolio, because you are getting married again to another GP. But if you have somebody that can build a portfolio of secondary shares in the same companies Marty's talking about, because a lot of them, their sponsors have fallen away and they're willing to do down rounds because they have good companies. And also Tom Bravo, another name here. Tom Bravo did it right. They didn't add money. Tom Bravo took every one of their portfolio companies and they put efficiency experts into each one to cut the cash burn without cutting the meat. That was the smartest thing I saw happen in the last bunch of years, instead of throwing more money at the same companies. So it's the same idea as the venture debt. Make sure that's not an impairment. Make sure you're not burning cash like, you're partying like there's no tomorrow. Why I don't spend time on Sand Hill Road, the Rosewood Hotel across the street at the bar. You can get every deal in Silicon Valley that you want, just go there. And they have good ideas, by the way, but then go back to Connecticut where I live and then run your venture fund for there. So I think time party on. More questions or any topic that I'll decline topics that I don't know anything about.
I don't know, there's an advent of new technology, I would think that things would become more volatile, but is that the case?
I just said that. I just said volatility. I didn't really get into volatility or arbitrage, but that's a complex strategy that I'll give you a perfect example. Take 1 second. So I was invested in a vol art fund in Singapore for a long time. Why? Because volatility in Asia is much higher than volatility in the rest of the world, and the instruments are still there because the markets still are pretty sophisticated. These guys ran flat for a decade. They somehow stayed in business, and they were in New York about a year and a half ago, and their performance looked like a dead person. And then suddenly, out of the blue, it started going like this all over again because they've been around a long time. I don't know how they survived, but they did. But the volatility was back. And so as an investor finding alpha, of course, I'm not suggesting, we're co-investors. I don't even run portfolios myself anymore, and I did it for decades. So we find other managers, other people to co-invest with who are doing all the hard work. I haven't traded an option in a very long time, to be honest with you. I only did it for 12 years and I wrote Black and Scholes models, but so I understand. But anyway, so those opportunities exist, and you don't have to dig that deep. Just do enough homework to understand the person you're investing in, that they understand their business, and they've got a 3-year track record, which 3 years is now good because 2019, 2020, 2021, et cetera. But if you went back 3 years ago, 3-year track record, you were looking at that whole 10 years where rates were zero, volatility was zero, defaults were zero. Those track records, just ignore them, throw them out the window.
So my only other statement on secondaries is that we did a panel on secondaries a couple of months back, and they concluded that more than half of all secondaries funding is going to continuation funds.
That was my
Whereas in
point.
2009,
Marty,
a lot of that was towards distress.
I get those every day in my inbox. So continuation fund, for whatever it's worth, GP does 15 funds in fund 1, fund 2, fund 3. Now that fund is either expired or their investors don't want a capital call. So of the 15 companies, they take 5 and then they do a continuation fund to fund those 5 for the next round. Well, let me ask you a question. If you were an original investor, how would you feel about that, number one? Number two, how good is that VC in picking the best 5 of the 15? Number three, are they picking the best 5, or are they picking the 5 that suit their business? Remember, their business, they're a general partner. They're not the investor, they're a general partner. So I'm very wary of continuation funds. And they're actually, the fact that there are continuation funds tells me there's alpha opportunity out there because they shouldn't even exist.
And maybe Chip can address when he speaks, the whole, he's not about right now, but maybe he can address the this marketplace that's kind of come out of the private markets of like series D, E, F, secondaries.
That's what I'm talking about, yeah.
I mean, that's remarkable.
So look at the underlying company and then look at the companies that aren't being, so remember I said those 15 companies? Well, maybe look at the other 10 that the continuation, by the way, continuation funds have had a terrible record of raising money, by the way. They haven't done well. Some of course.
So I'm just saying that 870 IPOs in 1998 versus 90 last year.
I'm 100% with you. So I'll finish with one statement, something that should not even exist. There is a secondary market in unfunded LP commitments. Do you understand what I mean? This is, I committed to invest X amount of money in your fund. You haven't even called it yet. So my dollar has not even been invested, but I will pay you to take my capital commitment away and from me. That shouldn't exist, because a dollar should be a dollar, and now I'm willing to pay you 10, 20 cents to take my obligation to fund the next round away, and I haven't even invested in it yet. That should not exist, so it tells you what's going on in the VC secondary world. That's it.
Can we move on to Paul? Great job.
Let's do it, absolutely.
Paul?
Thank you, and you'll leave the microphone.
Paul Foley's over online.
Oh, I'm sorry.
Do I just introduce Tyson, Paul?
Hey, Marty. Hey, I'm Paul Foley. I'm chair of the investment management practice at Ackerman. We represent hundreds of investment managers across the country, really from retail investors to family offices to every different type of fund manager. So I'm not nearly as skilled as these folks on the investment side. However, I work with the folks on the investment side every day. So, if anybody wants to not take Alfonso's recommendation, we'd be happy to help them start that hedge fund that, are very unpopular right now. And I even heard somebody in the audience mention, why would you even have active management? I grew up as a hedge fund attorney 20 years ago, and hedge funds were the hottest thing ever. And now, you get into it, and the markets have gone straight up for effectively 15 years. And who needs active management is what people say. I think you're going to see some real alpha with some active managers who are very smart, and I'm seeing that along with my clients, where it's not just getting the band back together. I mean, it's been a very difficult fundraising market for hedge funds over the last 10 years, unless you're one of the largest of them. And you're starting to really see very smart people with very strong expertise jump in. And, another big trend that I'm seeing, and really where you see the alpha strategies come in, comes with just the scale of all of the major players. The major hedge fund players are just so huge. The major private equity fund players are so huge. Everybody is so big. I think it creates a real opportunity. And I'm seeing that with a lot of my clients who are focused on deals that the largest private equity firms aren't focused on. There's just a lot more beta there. Alpha there, excuse me. There's just a lot more opportunity for those investors to do well. So those are areas that I'm seeing. We're doing funds in all different areas. Private credit, people are still doing a ton of private credit. I agree with the commentators. You start to, I think that's plateaued, and there's so many players in the private credit space who aren't ready and equipped to actually run the business, and that's a real problem for a lot of those folks. Venture is really difficult place, and we're seeing actually secondary capital commitment loans, where some investors, they want to get a loan on their capital commitment, and we have some new funds, and so they want to stay committed to the capital, but that they also want to take a loan on their capital commitment. So it's an interesting dynamic. I'd say venture space is really hurting. I have many multi-billion-dollar managers who are just having a really tough time in the venture space, but I think when good things happen I think there's a real opportunity there. On the private equity side, I've never seen, we're doing so many deals for investment managers. I've never seen anything like this. And in my office, we represent a number of big private equity roll-ups, but I'm doing a lot of roll-ups on the investment management side. I have a client who, this is a sell side, an RIA, about 500 million under management, and nothing has changed fundamentally in their business in the last 3 or 4 years. And 3 or 4 years ago, this company probably would have sold for about 8 or 9 million. They're under our LOI right now for 28 million. nothing has changed in that business other than the level of competition for those deals. But what's interesting on the investment manager side, I see a lot of like my clients who are RIAs who are talking to their buddy who's an RIA, and instead of paying 6 or 7 times gross or more of the revenue, they're paying 1 to 3, 2, 1.5. I mean, we're seeing those deals where there's the friendly deals. There's a lot of inefficiency in these smaller markets and in these smaller one-off deals, and we're seeing a lot of my private equity, or excuse me, family office clients really try to start doing some of the one-off smaller deals that aren't on the radars of a lot of the major players. So anyway, I know I don't have as much to add as some of these other folks, but I'm happy to answer any questions and talk with anybody about any of these things.
Just hold on a second. Hey, Paul, hold on a second here.
So, just real quick, where are you seeing fees these days and, the ability of some of these firms to be able to, collect on transactions and things like that?
I'm not seeing a tremendous amount of fee compression. At the largest scale, you see a real push on basis points and that kind of thing, but we're not seeing a tremendous amount of fee compression, even at the hedge funds. I mean, the larger sophisticated investors, the family offices will come in and negotiate a little bit of a deal, but we're not seeing a lot of fee compression across the board.
And do you think the issue with venture right now is more of a, price discovery issue and mark-to-market issue than necessarily a problem with venture itself?
I think there's definitely a mark-to-market issue. I mean, they actually, I mean, there was a lot bigger correction in the venture space, and raising capital was a lot more difficult for my venture capital clients, where on the private equity side, if they had to mark to market, I think a lot of the valuations would have made it so that it would have been extremely difficult to raise capital in the private equity side, but they already had so much dry capital, all the big private equity funds, that they're able to just buy from each other, and they're competing for deals that it kind of just makes them get through a cycle of depressed prices. I think that's what we've seen over the last 3 years, where they've been able to use their dry capital to continue to do deals at ever increasing valuations, when I don't know if they were marking to market, there'd be, or if there was an actual market for some of these, I think that would have created a real problem from a fundraising standpoint for many of those firms.
Yeah, one insight I want to give is that of the 1,300 unicorns in 2019, 20, and 21, half of the unicorns that were printed were healthcare unicorns, but no more, right? I mean, I think that there's a huge mark-to-market issue in the healthcare space right now, where so much money was raised and then there's no money right now for a lot of these deals. Any thoughts on that? Are you seeing it also?
I mean, we represent. I launched a lot of healthcare venture specific funds during those vintage years, and a lot of those funds are really hurting. We're seeing some interesting funds though launch on the healthcare side. There are a lot of opportunities, but again, these tend to be smaller opportunities that aren't the same the things that all the major players are going after, because these firms have gotten so big that the opportunity has to be so large that there's a lot of inefficiency in that smaller market.
Are you seeing the market, because you talked about the complexity of some of these funds today, et cetera, are you seeing the market moving more towards that complexity and regulatory environment than what used to be the old startup venture funds? I mean, probably before 2021, there were VC funds out of Silicon Valley were printing a fund, a vintage every year, right? That doesn't happen anymore, right?
Well, now we're starting to see where everybody wants to be evergreen with their liquid level 3 assets, and that's a really complicating factor, because from a regulatory standpoint, even with the new regulatory regime that I'm expecting, which will be, I think, welcome news for a lot of the industry. I mean, fraud's still going to be fraud, but even there, these evergreen vehicles, you've got a real valuation issue with level 3 assets, and letting people in and out at any given interval really creates a lot of problems. And there are a lot of people pushing for those kinds of products. I'm seeing it from some of my clients. And there are some law firms that are doing that. That's probably the scariest thing that I see, and I don't think that's going to end well.
Right. So that's the environment we're in. And so with respect to, private equity fee generation, and I'm not sure if you're involved in the real estate fund side as well.
Yes.
But I mean, it seems like there's new fees generated despite some compression on, the longer duration. Are you seeing that also that there's transactional fees that didn't exist before that are new into the game? Any thoughts?
I'm not seeing a lot of introduction of new fees. I am seeing when funds are in runoff, people finding ways to do successor funds where they basically sell their existing investments to a new fund, and then they're getting the higher fee as opposed to the runoff fee with respect to that, and they're getting the valuation marked up because usually in a private equity fund, the fees that you're generating are on the invested capital, not on the fair market value of those assets. So it is a way, these successor funds or additional funds is a way for them to generate more fees. On the real estate side, you can put any fee you want on a real estate fund as long as the math works. And we see, a whole plethora of all kinds of different things and different affiliates providing all different types of services depending on the sector. On the hotel side, we see it, you have the affiliated developer, you have an affiliated management company, you have an affiliated booking company. I mean, it's crazy how many different ways they can find ways to charge. But if the IRR works, the IRR works. So I'm not seeing a lot of new fees. The biggest things that I'm seeing are really strange strategies. Like we have a strategy where it's a patent troll funding fund. I'm doing a private equity fund that does minority investments in major sports franchises. A lot of different types of things as well. And then the crypto side, look, that the regulatory environment is never going to be better for crypto assets, and you can think what you want about them. And I know I was always not the biggest supporter, but I have a Coinbase account now since the election, and it's doing phenomenally well, and it's going to do phenomenally poorly, I suspect, at some point in the future. But I think there's a big wave to ride with respect to that as well.
Any thoughts on crypto with respect to the fund business in terms of regulatory, so a lot of people are arguing that applying crypto will reduce the need for regulatory filing, automatic compliance, things like that. Any thoughts on that?
I'm very torn with respect to the crypto industry, and there's a lot of great, interesting, innovative products there. Then there's a lot of fraud, and you take, in the 2000s, you take all the people who were in boiler rooms pitching different stocks, and they got kicked out of the securities industry, and now they're in the crypto industry. And so, I mean, that's not the entire industry, but there's still just a tremendous amount of fraud there. I have a very selective group or a very select group of crypto clients that are all really trying to do things correctly. I think there's going to be good regulation. I think there's going to be crypto is going to be brought out into the mainstream more in the next 4 years. That's my total expectation. And that needs to happen because fees are high, fraud is rampant. I mean, I feel like if you get on YouTube, you're just watching pump and dump after pump and dump. And I'm not talking about, even just the main players. There's just a million other of these kinds of coins and different ideas that a lot of people are going to lose a lot of money. And it's not going to go anywhere, and it's not being regulated currently. I think there are ways we can do things that are smart, that bring it out into the fore and into the public that will work. And at least if people are losing their money, they'll understand that they'll have done it with their eyes open.
Paul, any thoughts on, I asked, and I hope that Chip answered it, about all of these guys who are selling, secondaries and how duration has just expanded so much. And so like this, people have secondaries on series D, F, G. I mean, it goes out forever. Any thoughts on that?
We're seeing a ton of it. I have a few clients that are just that only specifically do secondaries, and they have their own secondary funds. I have a lot of clients who are trying to help investors get liquidity. it's a really, I think one of the things that's interesting here is it's a really spotty market because 10 years ago, or I'd say I'm seeing more defaults on capital commitments than I've ever seen before. And it's not because the funds are underperforming. It's that there's some people who are just really hurting. And, I get different sob stories from different investors and funds about why they can or can't make their capital commitment. I will say that if you come to the manager and you have a reasonable story and you're not a jerk, the manager is usually going to try to find a way to make that work for you. If you come to the manager and say you're going to the SEC about some bogus fraud, that's usually not going to be a winner for you if you do happen to run into one of those situations.
My understanding on if you don't make the payment into your managers is that they can wipe out some of your equity in the fund. Is that correct?
I'd say under our model documents and under most firms' model documents, you can wipe them out completely if you are a defaulting investor. I would say in reality that happens very rarely. We usually try to figure something out. Sometimes you take a discount. Usually the manager will try to find somebody else to purchase your interest if they can, without creating a market for those securities. There's a lot of different ways.
I think there's tremendous headline risk with that.
What's
right?
that?
There's headline risk.
Yeah, there's headline risk, and you don't want to have an investor who's a reasonable person really upset. I mean, sometimes these are just short-term things, and it's a small world. But at the same time, you have some investors that you're just never going to be able to make happy, and they throw around all kinds of fraudulent accusations that are false and defamatory, and sometimes you just have to defend yourself.
Sure, yeah. This is really great. Again, my opinion is I think that if I was 30 years old, this is a great time to be 30 years old with all of this industry coming back to the United States and all kinds of opportunities are going to be available and, really, entirely new ways of looking at things. So we're going to move over to Chip Perkins, who I've known for many years. Chip, why don't you tell us where you see the markets and where you see alphas being created?
Good morning. Is that on? Yeah. First of all, Marty, thank you for having me back. Appreciate it. Been an interesting panel so far, and Paul covered a lot of stuff that I was going to cover. So thank you, Paul.
I'm sorry. I'm really sorry.
It's okay. So I'm different than all of them. I'm not a lawyer. I'm not a money manager. I'm a placement agent. Appreciate it if y'all pick up our phone calls when we call you. That's an idea. And you younger ones, listen to your voice now, please. So I've been doing this since 1997, actually 96, somebody else. And I've seen a lot of markets, and I've also seen what Paul was talking about with lack of liquidity in the marketplace. And a lot of that you can almost blame back on private equity because they're not getting liquid and they're not giving you your money back. And it is still your money, even though they have it tied up. And it's a terribly difficult environment. I have always sold hedge funds, my firm. We've done some private equity, we've done some private deals, but for the most part, for the last 28 years, I've been in the hedge fund marketing business. I've got a broker dealer, I've got a team of 7 people. We've raised about $8 billion for people over that period of time. Not much in the last few years. Again, back to the liquidity. We look for managers that can create alpha. Now, what is alpha? What's your benchmark? How are you looking at it? Most investors think the S&P is the benchmark, but that's not the case with different kinds of managers. I've got a China manager, CMSCI, it's not the S&P. I think in a lot of times, you can do the math and you can, do like Andy, write code. I can't do that. But at the end of the day, alpha's in the eye of the beholder. It's like if you think that your managers, if you've selected the right manager, is making the kind of return that you expect, that's not bad. That's what you're looking for in all your investments. We try and find managers, as I said, that are consistently returning or are different, and opportunities to invest in something that you may not have seen previously. Right now, I've got a private credit guy, but he's loaning on real estate. I've got structured credit. He's doing CLOs. So we look for people that have done this before and done it for a long time. Marty, what was your question for me?
Yeah, what sector do you think is the right place to be in right now? I mean, I know that you did hedge fund for many years. I think maybe you've done some deals as well, but you never really touched too much in the private investment space, which probably at this point is smart, right?
Well, first of all, when I tried to get into privates originally, it was Tommy Lee, number 13. He didn't need my help. So nobody back in the 90s was really investing in startups, private equity firms. So we kind of took a path that was popular and went into hedge funds. But now people are looking for direct deals. They're looking for opportunities that other people don't have. They're also, but half of their portfolio, or 3/4 of their portfolio, is with the big guys. Oh, I don't lose. It's like when I worked at IBM years ago, I could sell IBM. People say, hey, if I buy IBM and it doesn't work, nobody's gonna blame me. It's the same sort of thing if you go into Paul Tudor Jones, you go into Citadel, you go into Millennium or whomever else, if you can get in, you're not gonna get in trouble with your boss. Because they've been doing it and they've been making money for 30 years. I think that right now, I think private credit is still a place that people want to be and should be. It's a steady kind of universe. My private credit guy and structured credit guy, they are making about a point a month. And that in this kind of risky environment is a solid return.
Do you think that the banking will remain the same? I mean, all you guys can address that in terms of, banks that pulled back, which is why private credit was able to expand. Do you think that banks will continue to be restrained, so to speak?
I think banks are trying to lower their risk curve. They're trying to get to a place where they're comfortable and settled into an environment. They're not making risky investments at all, even if they're secured by something. What do you think, Andy?
I think you're right on, and but banks are regulated entities. The regulation has become tighter, so they become more narrowly focused. But so I would differentiate the direct lending. If somebody says we're replacing the bank, run away, because banks never made a lot of money lending. So the specialty finance, I think, Chip, you talked about is where.
Yeah, I mean, specialty finance, like revenue financing, litigation finance,
trade finance,
receivable.
Each one of those is a specialty. You don't just give money out. Each one has a way of doing it that requires expertise and therefore alpha.
And if somebody says they can do it all, run away. Because you cannot be an expert in it.
But a lot of the big funds, our players have moved into some of the specialty finance, right? I mean,
yeah, but they have a lot of money and they can hire somebody here, somebody here, somebody here, somebody here. But the top 4 guys, they can't do it. They can hire the people that can do it. Sub-advisors, not even sub-advisors, they just Citadel, they just hire the team, yeah, it's good, pull a team out of someplace and they work with Citadel.
are there preferable teams that you see? I mean, it seems to me that if you're involved in private equity or venture, you really want to be in the top quartile, so to speak, because a lot of the other stuff isn't really any good, right? I mean, any thoughts on that in terms of, performance?
I think performance can go up and down, and you can be out of favor in the areas that you are known to be able to invest in. Not everybody's right all the time. But we talk about secondaries, right? That's become much more popular. But there's now large funds like Lexington and people like that build big businesses around selling secondaries. And if you are a family or an institution that is hit the wall on how much money they can put out because they have restraints, it can be a very good market. I'm finding people that are looking for secondaries.
Secondaries on individual stocks or secondaries on funds?
On companies.
Okay.
Primarily. On companies. I mean, BlackRock has quite a few billion dry powder to do that kind of thing right now. So there are people that are interested in secondaries, and there are a lot of people that are unfortunately in a situation where they have to default. And for the most part, when you default on a private equity investment, you lose your investment. You lose what you put in. It says so in the documents, usually maybe not most, but most people's documents just say, hey, you're done. Thanks for coming. So I've had people told me for different years, because I had a fund that was a 5-year lockup, and it was averaging a dividend of about 8 or 9% a year. People said, look, I'm not gonna lock up. I always get 22% for my private investments. I said, well, how come you're not getting any liquidity for your private investments? They can't sell them, they're not going public, there's no market for it. And they're not getting always 22% of investments. So the overall market's changing. I think another thing that was said earlier is, our stock pickers are going to come back. I think they are. People that have an edge or are done it for a while will come back and be able to perform well. Probably with the help of AI, Elliot, but I think that's you still want to hire people that are smart people, no matter what the technology is. And choose something that you know something about when you're making your investments. Don't just blindly give your money away to something you have no idea, you can't figure out, or they can't explain to you what it is that they're doing.
So do you see the runway right now for capital raising in the space to be with, lift outs from, great financial firms? Is that primarily where it is right now, or are there new ideas that come out of left field?
Well, capital raising is incredibly difficult now, and has been for a while. I don't know how I convinced my son Sam to join me in this. He had a good job. But I think that what's different is just people looking at their portfolio and making decisions if they're ready to try something different or try somebody different, and redeeming from Peter to pay Paul or mess with Paul. I don't think that you mentioned 25%. Nobody wants to invest in somebody who's not in the top 25% of their area. And that's usually pretty simple and available. But the market in general, the bigger getting bigger, and there is risk with some of the smaller guys. But if you're, somebody's running $100 million, you got to remember how much money that there is. I mean, it's a ton of money. If somebody's raising capital and has $2 or $3 million, there's real risk there. You've got to really have a strong connection with them, or just really deep pockets.
Great. Any closing comments? Why don't we start with Tyson? Tyson, do you want to give us some closing comments?
Well, I think that if things get difficult, getting big fat dividends, such as what I had proposed, really makes a lot of sense. I mean, I think that there are a lot of ideas here that are very appealing for institutional investors, but I've been surprised to see the likes of Bill Gross is a buyer of closed-end funds, and other, portfolio managers that are worth billions of dollars will pick up these opportunities. And I think that you do want to, invest as sort of a contrary investor, and that's not where everyone is. And I think that we've had this huge lift in the U.S. equity markets, and I like the income strategy that I've laid out, and I think for non-institutional investors, that is a good place to be, because if you're taking in 8% per year in terms of predictable income, that's a lot better than I'm envisioning a lot of people who are saying that they can't make their commitments here are in trouble. And frankly, the markets haven't even gotten ugly, so they will at some point. So I think it's a very sensible thing now that you get paid to be in fixed income or yield, to take that opportunity and capitalize on it.
Great. Andy?
Can I ask my colleague a question?
Sure.
Does that work? So you took AI and you look at the fundamentals of, I guess, I'm sorry, I need it.
You break another one?
So, got it. So he takes AI and looks at, and a bunch of algorithms, looks at the fundamentals across, I guess, all the listed companies. Was there 8,000 or something? What are you, because we were talking about these, the ones driving the S&P 500 and everything else. What are you seeing from your lens of the differentiation? Because that's where alpha comes from. Chip was talking about that. The alpha comes from the ability of managers to find differentiation.
To make sure I understand the questions, are you talking about sectors, market cap?
Any factor that you find is a differentiator amongst the whole universe of companies.
Yeah.
You pick it.
Yeah, so it is pretty easy to use the S&P 500 as a benchmark because it's being driven by the top 5 stocks. And if you can find any company that has the prospects of going up 19%, I use the example of Fox Corporation. We bought it, went up 19% over the same period of time. S&P 500 did 4.4%. That's alpha, and that's a result of combining corporate fundamental data, comparable companies in the industry, and market data. That's one source of alpha. The second source of alpha is really focusing on risk management. And I pass on a ton of opportunities where it's 15% or 20%, but we might have to risk 10%. And when you do the math on that, you're risking 50 cents to make $1. It doesn't make any sense to me. I'll take an investment at 12%, I'm only risking 1%. And so that's another huge source of alpha. And then understanding accounting, one of the things is my big strength is accounting. And being able to write a code that can floss through accounting. Actually it's a whole other conversation because I one of the reasons I don't use data providers is because I disagree with a lot of their data, which is a whole nother topic, but it's a huge source of alpha for me to not use data terminals.
Great. That's interesting. Do you have a closing comment, either one of you?
It's just that I think if you took Tyson's intro, the days of easy beta are gone. And if you're playing with gold and Bitcoin, it's nothing, I have no opinion it's going up or down. But if you are looking at preservation of wealth, catastrophic loss of capital is your risk factor that you should be thinking about. Tyson was just talking about income. I was talking about versions of loans that are relatively safe. So, but even the growth side, which is why I asked this question here, on the growth side, what is the way to keep your risk down, protect your capital. And you can take your play money and do all the Bitcoin and gold investing you want, but I don't know anybody, short of the people that already introduced, that want all of their wealth in something like
I would just say that, I don't want misconceptions within investors. Placement agents, third-party marketers that call on you are actually on your side. Yes, they want your money, we want your money, but we get paid on the performance of the manager. So we don't pay managers that can't perform, that haven't been vetted. And we get watched over by the SEC and FINRA. And if we screw up, we can go to jail. So don't be afraid to answer your phone, send an email back, because we really are on your side. We want to have our managers filled up, but we want you all to profit from that.
I have a folder for purpose marketing if you want stuff from the team or something.
Is that in the database?
Mark.
Ellie, any closing remarks?
No comment.
All right, guess we're done. Thank you, guys.
Great job, guys. We're gonna start with the healthcare panel, and let everybody come on up. Thanks.